Right. Well, that was a good lead in. That chart says it all, really, to me, and I'll get into that. I understand this is a very sophisticated crowd, so I'm going to go relatively quickly. I'm also told I've got 15 minutes. I typically would take probably 40 minutes for this, but I'm going to go through it quickly because I think most of you are up to speed. So we really talk about going tech or going extinct now in the context of how to reboot a company coming out of this pandemic. And you see things that you've just never seen before. I mean, this is just quite amazing that the Dow would have the best week ever, or since 1938, while millions of Americans are losing their jobs. I'll come back to this, but as of today, the Nasdaq is actually up year to date. It's actually up, where the FTSE 100 is down about 20%, and the Italian MIB index is down about 27%, which is interesting in and of itself. But crazy things we're seeing, one way or the other. We know that things are not going back to normal. That e-commerce chart just says it all. And if we learn today and we learn how to adapt today, we can have the opportunity to sail tomorrow. It's absolutely possible. And that's the thing I'd like to touch on today. Disruption has accelerated the need for automation across now almost every single industry, across companies' entire value chain, starting with supply chain and logistics. We've been seeing this automation for years, but it's really just accelerated. McKinsey pointed out in an article last month that digital strategy that was once mapped out in 1 to 3 year phases are now happening in a matter of days or weeks. And I've got a few examples here. We have Disney and Disney Plus. They projected it would take 4 years to get to 55 million subscribers. They did it in 6 months or within 6 months. And Tesco is another company that's adapted incredibly rapidly to online commerce. Now, because this point of resiliency being so important today, more than ever before, I want to look at the value of resiliency. And here I'm putting up a chart of 3 UK companies who are in the supermarket business. We have Tesco, Sainsbury's, and Ocado. Tesco's has something like 450,000 employees. I think Sainsbury's has nearly 200,000 employees, and Ocado only has about 15,000 employees. And yet Ocado is performing extremely well, even though it's nowhere nearly as profitable as these two companies. But what's especially interesting here, this is just over the last 2.5 years, is how they've performed since the pandemic, since the lockdown started. And this is a lesson, I think, for all companies in all industries. Ocado is essentially a technology company. It does deliver groceries in the UK, doesn't have any stores, but it delivers groceries through its automated warehouse and delivery vans, and many of you may be familiar with it. Whereas Tesco and Sainsbury's have probably 90% of their revenue tied up in physical stores. And they're only now still learning how to do online e-commerce, and the market is rewarding the company that has become most resilient, most automated, and frankly, most ready for the future. And Tim Steiner at Ocado will be the first to tell you that they have a plan ultimately to be able to run this company with almost no employees, apart from the employees that are designing the operations, designing the company. But otherwise, everything else can be automated. And this is frankly where everything is going. We look at where this puck is going to tech. We look at the market performance since I call it this is a mini crash. This is not the big one. So in this mini crash correction, we could say that we've had from say mid-February highs to March 27th, which is where the bottom, short-term bottom has ended. We see something very interesting, in that if you've been an investor in these U.S. tech indices and some of the biggest U.S. tech companies, you wouldn't have lost a lot of money. But more importantly, you wouldn't have had to go back much in time before you were losing money. So in the case of NASDAQ, this is when we hit the bottom, March 27th. If you had invested in May 2019, you'd still be up. But if you had invested in the FTSE 100 in May 19, you'd be down. In fact, you have to go back to before February 2012 to still be up. And we see a similar dynamic with the Stocks 600 Europe, DAX 30 and CAC 40, and also in the MIB in Italy. So there's a lesson here. There's a lesson here in terms of the power of tech. Now, if we just look at last year, 2019 returns, and this first quarter, last year tech was the best performing sector by far, was up 50%, 50%. Q1, interestingly, tech was the best performing apart from utilities. In other words, it lost the least amount of returns or funds. And what you could interpret from this is that the risk reward rule is broken. This doesn't follow risk reward. This should mean, well, this is higher reward. You're taking higher risk in tech. It should mean when you have a reverse of that equation, you're going to have a bigger loss. And that has not happened. The opposite has happened. So what does this mean for you and your company? Well, I'd like to start with what your investors think. So BCG has been surveying investors since this pandemic started. And in this survey from March 20th to 22nd, they talked to portfolio managers and senior analysts who are responsible for making the important buy, sell, and hold decisions. This is representing $4 trillion of AUM. And what did they say about the critical decisions and actions that corporate executives and boards have to consider today? Well, again, very interestingly, in addition to the near-term fire extinguisher to deal with a crisis, they're saying we want boards and management teams to focus on the medium-term health. We want them to prioritize building key business capabilities to create advantage and drive future growth. And very interestingly, they're saying, even if it means lowering earnings per share guidance and delivering below consensus estimates. So they're almost saying, we want you to learn how to adapt to ride that bull where it's knocking you about so that you can sail and we can benefit from your sailing in 2 or 3 years' time. And this even extends to something that surprised me, which is that 60% of these investors are saying to the companies that still have a financially healthy balance sheet to take advantage of today's low valuations and actively pursue acquisitions to strengthen the business. So unlike many of the senior executives at our large corporate clients who are saying to us, well, you know, we're really battening down the hatches. We're cutting costs across the board, OPEX, CAPEX. We're cutting all travel and entertainment. We're cutting all consultancy budgets. You know, well, that may not be necessarily the thing to jump to. It's a natural reaction, but the investors are saying, hold on, this is an opportunity to take advantage and to grow. So what does it mean for you and your company? What it really means is you've got to skate to where the puck is going to be, not to where it has been. This is especially true for any established legacy corporate that's been in business for 100 years or 150 years. This is the time to reinvent yourself. Tech-based business models, they're taking over the world. If you go back 10 years, you'll see that 9 out of the 10 largest tech companies in the world, largest companies in the world, were non-tech. 3 of them were in oil and gas. Only 1 was tech, that was Microsoft. Now we have 7 of the 10 largest companies in the world are tech companies, and it's growing exponentially. In fact, 2 of the 3 non-tech companies, Visa and Berkshire Hathaway, are basically becoming tech. And we see this in the NASDAQ. So we often don't take the 30-year time frame, but if we do go back to 1990, including this dot-com boom and bust, the NASDAQ, which is tech heavy, is growing exponentially, has grown 1,900% in the last 30 years. The FTSE 100, again, you'll see the same thing with the CAC, the DAX 30, and the MIB, you know, is essentially flat. Now, this doesn't include dividends, so it may be up by another 100 or 200% with dividends, but still, it's not the future. It's not to where the puck is going. And if we look at smaller companies, at unicorns, they're also growing exponentially. In 2013, we only had about 20 unicorns. These are private companies valued at over $1 billion. Today, they're over 400. I mean, it's probably not 464 today. It's probably more like 400, given the prices. But the point here is that unlike perhaps in 2002, 2003, 2004, when many of us so-called tech experts, you know, weren't sure if tech was coming back, we can now predict, forecast, assume with a very high level of certainty that tech is not going away. It's not going to be damaged by a market crash, a world depression, hyperinflation. It's here to stay because it's growing everywhere. There are over 100 companies being funded and founded every single day. Pre-COVID, it was $1 billion a day going into these new companies that are being founded. Now it's probably 400 to 500 million or a bit less. Just a question of what time frame we're talking about. But advanced technology is exponentially taking over the world. It's penetrating every single industry. Like that e-commerce chart that Alessandro showed, it's exponential. So name an industry sector and put tech after it, you'll find it. And you'll find thousands of companies, even in obscure categories like wine tech, where we found over 600 companies around the world. This is going to change even more disruption with 5G. So 5G is being built out now, of course, but by 2022, I would expect serious industrial impact across all industries. And this is mainly a good thing, but you have to know for yourself how it's going to affect you. But in terms of being able to use augmented reality, virtual reality, not just for self-driving electric vehicles, but for entertainment, to be able to project on a hologram a boxing match in your living room with haptic technology, that's not 10 years away. It is not. It is 2, 3, 4 years away. It is coming. And the way that you can think about it, I think, is how does it affect your customers, your consumers, and their behavior? And how's that behavior going to be reflected in their purchasing or using your product? The key to this is that it's not just another trend. We saw the studies done at the end of December 2019 that the last decade was the decade of tech compared to previous decades where it would have been the decade of commodities or oil and gas. I think we've seen the last of that. I think every decade from now until the end of time will be the decade of tech because we're racing towards the singularity. And the investment firm DWS essentially said that much when it said, this is back in April, the triumph of technology stocks is not cyclical anymore. This is going to extend for more than a decade. And we see certain companies that are smart enough, that have the vision and the ability to execute on it. So you might recall that we had this big thing called a financial crisis back in 08, 09 in the US. GM and Ford, you might recall, were bankrupt, and they had to be bailed out by the US government. And they were bailed out, and they were reissued, IPO'd back to the public. And they were a effective pair trade. I mean, they tracked each other extremely closely until something happened. And that thing that happened was GM in March 2016 agreeing to pay up front about $600 million for a zero revenue self-driving software company called Cruise Automation that had, I think, about 25 employees. Why did GM do that? Well, GM saw that its future over the next 10 years was going to be completely different. That in 10 years' time, we're not going to have vehicles that are driven by human beings on petrol, but we're going to have self-driving electric vehicles of all different shapes and sizes and forms. And they decided they couldn't do it in-house, so they had to acquire the very best software company with the right team that they could find. And that was in the form of Cruise. And what we saw here is over the following years, this is the pandemic correction, so it's hard to include that given the uncertainty. It formed a huge gap with Ford in terms of how GM treated the Cruise employees. It's almost a reverse takeover. It's a great story. So I don't know how much more time I have. I'll race to the rest, but Klaus Schwab said it all in his book, The Fourth Industrial Revolution, that decision makers, and I see this every single day, now more than ever, frankly, in the crisis, they're too absorbed by the things that are right in front of them. It's today or next week or it's next quarter or this year's budget, or it's the crisis. We've got to cut costs. Yes, we have to use the fire extinguisher when there's a fire, but we can't take our eye off the ball of the forces of disruption and innovation that shape our future. Sears took its eye off the ball. It was the number one retailer up to 1990 in the U.S. Number one, $53 billion in revenue, down to $16 billion in revenue, and it filed for bankruptcy in 2018. GE, we already forget about GE, but back in 2000, this was the shining star in the U.S. It was the leading industrial company, one of the leading companies in the world. And really, it should have been the world's first trillion-dollar company. But a lot happened, and there's a lot of opinions about GE. Certainly, they misallocated resource and they overpaid for certain acquisitions. But one thing they didn't do was focus enough on those forces of disruption and innovation shaping our future. And when they tried to, quote, become a software company, they tried to do it all in-house. And Jeff Immelt himself said, look, if we were to do anything other than do everything in-house when it comes to software and innovation, Thomas Edison, our founder, would rise from the grave and shoot me. And I think that's, frankly, the essence of what went wrong with GE. They didn't think outside of themselves and how to partner with where that puck was going. Thomas Cook, another one in the UK, this company was around for 178 years, 10 billion pounds in revenue, 20,000 employees. It wasn't like they didn't see it coming. I don't know if you know the story of Kodak, but this share price chart looks just like Kodak's. Kodak knew that the digital camera was coming because it owned the patents to it. But if you look at that 10-year share price chart, it's just like this. The board knew it was happening, and they let it happen. They were asleep. Thomas Cook was asleep. They were more worried about refinancing their senior debt facility rather than realizing that their 500 stores were not needed anymore by consumers who could book their holiday on their mobile phone. if we look at the Dow Jones, I didn't talk about this earlier. I just think this is such an important point that the Dow Jones companies tend to be larger companies than the companies, for example, in the FTSE 100. So you'd think if they're larger, they're elephants, and they shouldn't be as nimble. They shouldn't be growing faster. They shouldn't be creating more value. But what we see here is that in this same March 27th market correction, the FTSE 100 investors lost 8 years, 8 years, whereas the investors in the Dow Jones companies lost only 2.5 years. And the reason is, yes, there are tech companies like Apple and Microsoft in the Dow, but a lot of the non-tech companies like Home Depot and McDonald's and Caterpillar and Walmart are becoming tech companies. They get it, and they're executing by acquiring tech companies and investing in tech companies. You might say we can't become a tech company. We're not like Google. I'll just point out quickly, this is Amazon, what it looked like in 1996. It was nothing. It was a puny little $20 million revenue company that had no bricks, no mortar, no stores, no nothing. And look at it today. We all know Amazon today. It's $1 trillion company. And it's Amazon's mindset, and Jeff Bezos saying it's always day one, that created this. And they're not finished. Jeff Bezos would be the first to tell you they're just getting started. So there is no limit to what you can do, no matter how small you may feel you are when it comes to technology, or how weak you may think your balance sheet is. Believe it or not, you can be creative and you can find a way to make it happen. I hear all the time we can't pay the valuations that are required for these tech companies that are raising all this capital. Well, I'll just say Andy Grove comes in here with his great comment, only the paranoid survive. And we have a couple of stories. I'm not going to spend much time on this. You probably know the stories of Naspers, but Naspers was one of those companies facing a crisis. It was on its knees. It was a traditional publisher, the number one publisher in South Africa, a couple of billion in revenue. And when the dot-com peak ended, I mean, it just had some eyeballs on a few websites. That's why it went up here like every other company in media. But when that crash started, it was in trouble. It was frankly facing the end. It was going to go extinct. And Koos Becker, a visionary leader, said, we're not going to go extinct. We're going to find a way out of this. They decided it was China. They spent $100 million on a failed ISP in China. That wasn't enough. He said, okay, we failed. And that $100 million was precious. But he said, we're going to do it. And they took time to do all their homework and their research, and they decided to spend a precious $32 million for 46.5% of a small little company in China called Tencent, even while they were in a crash. And that's something we take for granted. It wasn't like everything's okay now, we can invest. It was, the world was crashing, and they still did it. And I think we know now what the story is. This has turned into a phenomenal success, where the $2 billion valuation of Naspers went to over $150 billion in value. And it became one of the world's leading digital media companies, including investing in many of the great companies we're of today. There's also the story, I won't go into great deal, Walmart, incredible story. 30 years ago, a big retailer in the US, all of the CapEx was on their stores. Nothing on IT or digital. Today, it's a completely different company. What happened was, back in early 2015, it wasn't just Amazon, it was Walmart feeling the threat from Amazon penetrating its market from books. Also, they had to change minimum wage and so on. So Walmart, as a very big company, had a massive decline here, whereas Amazon doubled its price. So Walmart knew it had to do something. It was already thinking this way. And they acquired Jet.com for $3 billion cash at a 13 times revenue multiple, which was shocking. I could go on and on about it. But basically, that acquisition brought in the talent and the mindset to Walmart that started to begin the transformation of Walmart that it is today. Walmart today, in fact, there was the quarterly announcement yesterday, phenomenal return, because Walmart smartly has grocery business that's allowed it to keep its retail operations open where its competitors have not. It's been an incredible success. And Mark Lohr, who's the CEO founder of Jet, has been the head of Walmart's e-commerce operation now for several years. And they just shut down Jet. He said, look, we've transcended that. And it's strengthening the Walmart brand now that matters. And Walmart is filing patents across this entire value chain in all of these interesting digital areas. And its mindset is, look, the same as Andy Grove. We could go away at any minute, the CEO, Doug McMillon, said last year. Now, I'll go quickly through this. If we acquire a tech company, the employees are going to leave. We know the story of Toys R Us, big company. It failed and went bankrupt. McDonald's, incredible story, where they are always thinking about the forces of disruption and innovation, not the thing that's right in front of them. They acquired a company last year called Dynamic Yield at a 17 times revenue multiple, not because of just the technology, the platform, or the revenue, or the customers. It was a great company that they'd been working with for a while before. It was the global chief information officer, Daniel Henry, said, it's more about the people, the data scientists that come with it, people that come with it, and their ability to move quickly with us. So they weren't worried that the people were going to leave them. Of course, that might happen. That's always a risk. But because they did incredible work with those people before they actually did the deal, those people are excited about changing the world with McDonald's. And they may leave, but the way this deal was done is they're unlikely to leave. They're unlikely to stay because they're still a team. And when people love working together as a team because they're winning and they're growing, they're not necessarily wanting to leave that, whether they're a part of McDonald's or not. So just to summarize here, I like this quote in one of McKinsey's articles last month. And I think this is so important. They said, just as digital platforms have disrupted value pools and value chains in the past, this pandemic, this crisis will create similar ecosystem level changes in motion, not just new changes in economics, but new ways of serving customers. That's what it all comes back to, is customers. And that's what's changing so rapidly. Look at the e-commerce chart. And across traditional industry boundaries. This is the big one. This is the, we could do a whole webinar just on that. We saw this quote from Mike Moritz a few weeks ago saying, we've all been turbocharged into the future by 5 years. I've just put up some companies here we're familiar with. You might have heard of, certainly Zoom, which we're using now. But companies like Beyond Meat, now worth $8 billion, it's worth half of Tyson Foods. Even though Beyond Meat has a couple $100 million in revenue, Tyson Foods has $40 billion in revenue. It's just incredible things that are happening at the moment. I'm not going to go through this. This is a slide we typically use for showing what the strengths are of corporates versus what the weaknesses are of tech startups and how they complement each other, and vice versa. And when you put all that together, the great technology, the great talent, you put together a corporate's clients, its channel, its brands, you get power. You get power. And you're not going to go extinct if you're powerful. And the time is now. We know that prices are coming down. You may have seen last week, it was reported that Monzo's latest funding round was done at a 40% discount to the previous round. Okay, I personally believe things are just starting, and we're going to see increasing pressure over the next 6 to 12 months. This is a phenomenal time for corporates to be in there looking at what we call the crash list, and there are plenty of opportunities out there. This is just some example companies for a food retailer or grocer. You can do this in every industry, and there would be 10 to 20,000 companies that are interesting to consider. Look, you're not going to acquire them. Think about a strategic investment that will be exclusive, or an exclusive JV. So it's all about, if you're going to go tech, you got to know what you're doing. We have a 12-step methodology we call Techquisition. It's all about being very, very, very careful and methodical so that you're reducing risk all along the way while you're increasing your value, so that by the time you actually get to completing your deal, there's almost no risk to that deal apart from the risk that you can't control, or the risk that is literally unpredictable, and that's where you want to be. You also have a pretty high probability of knowing how that deal is going to pay off. And this is today, certainly, we believe, the fastest, the best way to turbocharge your rebooting. So that's it. That's what we do. We help established companies transform themselves. If you want to talk to me after Duccio, anytime, there are my contact details, which you can also get from Alessandro. And I think we're going to do some Q&A as well after Duccio presents.